Welcome to episode 44 of Accessible Finance, where we demystify personal financial topics and answer your questions so you leave saying, I get it now. I'm Eric Johns.
And I'm Rachel Johns.
Let's dive in.
What is funny?
I still don't know the intro. I still need to read. It's one whole sentence long.
Well, better to read than mess it up.
I do have a pin though, so we're good.
Oh, Lord. All right.
Let's roll.
So, welcome to part 6 of our retirement series. This is where we're going to really talk. We've kind of gone through the start of looking at retirement through retirement. Our last episode discussed kind of the end phase of retirement. And so, last but not least, we are touching upon estate considerations.
Right.
Wow.
I almost dropped my pin. Almost. Doesn't count, so we're happy still. Let's go.
Too
Proceed.
excited about the estate consideration.
Proceed.
All right. So oftentimes, when we're talking about estate considerations, this is yet again an area where there's a lot of room for differentiation based upon what the client or what the individual would like.
Absolutely.
So what are the most common types of like estate planning that you see people wanting?
There are probably three broad buckets. One is I want to maximize the amount of wealth that I can transfer to my children, my offspring, my lineage, right? The second is I want to maximize the amount of wealth transferred to a charity. The third is I want to maximize the amount of wealth I get, right? So,
Yeah.
and that's look, there is
All are fine.
no judgment
Yes.
on our part.
Yes.
It's not our job
Okay.
to pass value judgments on your decisions.
Yep.
It is just our job to give you the options and then make of them like execute
Yeah.
your plans optimally.
Correct.
Right. So that's the idea. But yeah, so these three kind of broad generalization categories require very different solutions.
Mhm.
Okay. So
So
you
let's
want me to
do
just
this.
go straight into that?
No.
We could talk
I was
about
gonna say,
Roth,
you're on the
Roth
edge.
IRAs and tax
Okay.
considerations.
Okay, we'll
I
get there.
got excited.
Okay, so let's do this. I think that what we'll
You reel
do
me back in.
is, yes,
I don't know how I feel about that.
this is my life. I think that it's important to talk about all of the considerations from start to finish of, okay, I'm ready to start planning my estate. I'm ready to start crafting my will. And then at each phase, at each step, we can talk about how would it look different for each of those three
Okay.
buckets, right?
Sure.
So the first thing that you should be really looking at is which of these three categories do I fit into, or is there another option that I want for myself, right? So
It could be a mix of more than one. So.
sure, for sure. You may want to have half of what you have left to your kids and half to a charity, right? You may say, I don't want to maximize the amount that's left to my children. I might want to leave my children X amount
A
of
lot of
money,
people do that. Yeah, yeah.
right?
Warren
Like a
Buffett said, I
set
want to
amount.
leave my kids enough money to do anything, but not nothing.
I love that, actually.
So
Wise words. But
smart
I
guy.
think that
Pretty good at the game.
right. But I think that the first phase of looking at your estate planning is trying to determine for yourself what you want that to look like, right? Like what is your idea
Yeah.
for, the legacy you're leaving behind.
Okay.
So then after that, right, it's important to go through and inventory the assets that you have to make sure that you have a comprehensive listing in your will. This is going to look different depending upon, what you have,
Accumulated?
yes,
Sure.
throughout your life. But making sure that you are aware of what things need to be included in the will, what beneficiaries you may want listed as specific things, if there are sentimental things you want to leave to individuals, so on and so forth. Yes.
Yes. Real brief point to interject.
Yeah.
Um, a lot of people seem to be a bit unclear on who would need. We're talking about quantifying the total amount of assets, right?
Mhm.
And there are a number of reasons to do this. Not the least of which is we've been approached, by prospects before that say, "Hey, look, I think I have an estate problem.
Yes.
Do I have an estate problem? I have, say, $3 million."
Mhm.
More like, well, no, not really, right? Because the exclusion this year is 13-ish ballpark, 13 mil, and then it could go up and then halve, but we're still talking about 7. Okay, with the expiration of the Tax Cuts and Jobs Act, we talked about that a number of times. I'm sure people are sick of hearing it at this point. But if you just got just have a few $1,000,000, right? Like I only have 3 million. Correct.
But,
Exactly. You should be proud of
um,
yourself. But the idea is you might not need a lot of these complex planning tools
right.
because you can utilize things, and we'll just say it right here. The lowest hanging fruit is going to be annual gift exclusions. What does that mean? That means I can give $18,000 in tax year 2024 to an unlimited number of
Humans.
persons. Okay. You have an unlimited spousal, um, exemption, but that's neither here nor there.
That doesn't really necessarily
Right.
change the
But
pot.
I could give $18,000 to each of my kids and then literally everyone I know
Yeah.
if I wanted to, right? So you can just, as long as it doesn't exclude 18K, you're good to go. And then you can split gift, which is just, we can each
I was
give
gonna say,
18K.
yes,
But the idea is that is the lowest hanging fruit. That
correct.
does not require a trust.
Yeah.
That does not require,
Mhm.
irrevocable life insurance trust, like no ILETs, no estate
Require
attorneys
any of the
involved.
complicated pieces that
You're not filing any
correct.
709s.
And what we've seen a lot is, we have 3 children. What we've seen a lot is parents who say, "Okay, I want to gift 18,000 to each of my kids." But
Mhm.
then if they're married, you can gift an additional 18,000 to their spouse. So you're
Correct.
essentially like double gifting to the cause of your children
Correct.
while staying underneath the threshold.
Absolutely. And
I
then
feel
you
like
can
it
gift
makes
to
common.
their kids, so your
Correct.
grandkids.
Correct. Correct.
You can gift in a number of ways. You can actually give 5 years to 529 accounts on the front end,
Yes,
and then just
which
not gift for 5 years. You're correct. We've mentioned it before, but when we're talking about estate planning, that is one.
so
That
there
is
are
a
ways to
consideration.
kind of adjust that number without going the route of
Right.
meeting with an estate attorney and trying to
So
establish some really complicated
correct.
legal
Often I
vehicles.
will say that those routes are often even kind of, and I don't want to say shunned, or the estate attorneys are pretty happy when you're going to them saying, "Hey, make me this trust," or
Absolutely.
put me in a trust,
Right.
put my
Let
assets in
me
a
hire
trust."
you. Right.
Correct. They're gonna enjoy collecting their hourly,
Yeah.
but there are, some attorneys that are pretty, high integrity individuals that'll say, "Look, you probably don't need this level of complexity," and they'll at least point out to you that a lot of their clients do not enjoy the level of complexity that these trusts, bring to your life.
Correct. And so we'll touch on that in our very next phase, actually.
Oops. I'm
No,
sorry. I apologize.
the
Jeez.
only other real consideration as well that when it comes to listing out or inventorying what your assets are is that um if you're a collector, if you're somebody who has items that are harder to quantify or sell, right? You don't want to be in a position where it ends up at an estate sale or something like that where the people are not understanding the value of it.
Okay,
So
we're talking Magic the Gathering. I like it. Thanks for bringing that up.
you are. You are. Down here though in the New Orleans area, there are a lot of like antiques and people are really into that kind of stuff as well. So really important if you have something that is valued heavily or if you have a child, niece, nephew, whoever, where you're like, I really want this item to go to them, it has to be specified in that will. And so you need to make sure that you're picking out what that piece is and listing that beneficiary there.
Okay.
Okay. So then you've gone through, you've decided what you want your estate to look like, where you want the funds to go. You've identified what your items are. You've thought about who your beneficiaries are. So now it's time to look at what kind of legal and tax advantage strategies you have to meet the goals that you've listed. So,
Okay.
like you said, and for the purpose of this podcast, I think in trying to maintain some simplicity, I think we'll just kind of hang out in those 3 buckets
Okay.
while acknowledging that there can be any number of hybrids or variations from there.
Oh, great.
Yeah. Okay.
Great.
You're
I just wanted to say something briefly.
happy though.
I'm happy about
Yeah.
this. But I also wanted to say, look, if you guys have some like really granular specific situations you want addressed, just write an email or, call in or leave us a voicemail or however you want to do it, right? Probably email is reasonable.
Give us
Just
the details you
we'll
want.
anonymize it,
Yeah.
and you can be Bonnie and Clyde and
Yeah.
we'll talk about assets in round numbers
Mm.
and kind of give you an idea.
We probably want to pick different pseudonyms, but yeah.
Well, I mean, it's whatever's fun. Whatever's fun for you.
We have to make it to retirement to in a
Touche.
okay. Okay.
It's kind of fun though.
So, so Eric, let's start with the first scenario, which was I want to leave as much money to my kids as I can.
Got it.
Okay.
So what we're doing in this scenario, probably from we talked a little bit about this from like a withdrawal standpoint and a cash flow standpoint, and what kind of assets you're going to be invested in going into retirement if this is your goal. Um, and a lot of it's going to hinge on your risk tolerance and everything else. But generally speaking, painting with a very broad,
Mhm.
not compliant brush. Okay. again, this is not advice by any stretch of the imagination, but generally speaking, if you want to maximize what you're gifting to your kids, you're gonna be more interested in strategies like Roth conversions or Roth savings in general. Why is that? Because not only is it going to be advantageous for you if you're going to do the Roth ladder or Roth conversion ladders or Roth savings because it's going to be playing the arbitrage on your tax rates,
Mhm.
right? Like you're not only going to be doing that, but your kids are going to have a tax rate too. Presumably, they're going to be employed and working,
Right.
and so therefore they're going to benefit more from the Roth, like especially if it's a large dollar amount. When they withdraw it, like it's still taxable to your estate, but then assuming your estate is tax free, or once the estate taxes are paid on that amount, when the children go to withdraw those funds they don't pay taxes on when they take them out. Does that make sense? They have 10 years to distribute it,
Yep.
okay? And then they can rip it all out tax free completely.
Mhm.
So if I have $1 million in a Roth IRA and I leave it to my son, and he's now a doctor, okay? We leave it to Connor, and Connor's a doctor. He's a nuclear physicist and a physician somehow, okay? So
That's
this
his
happened.
dream, by the way.
Yeah,
So
probably.
he wants to be a scientist on the weekdays and a doctor on the
Yeah.
weekends.
So Connor is in the
Yeah.
37% tax bracket because he's running, Johns Hopkins or something.
Yeah.
He's in the 37% tax bracket and he has this $1 million Roth IRA. He's going to pull that out and pay zero extra dollars in taxes. He's going to pay zero tax on that $1 million. Now he has $1 million extra in his brokerage or his taxable account,
Yeah.
and he hasn't paid any money on it. If that were tax deferred, if we had it in an IRA
Yeah.
and then he gets it and he rips out that $1 million, he's paying
600,000 now.
well, he's
Yeah.
paying $370,000 of tax,
Right.
right? 37% of the
Around it.
That's
But yes,
fair.
exactly. And I think that that's the most important thing is that, and we see this a lot, whether it's, with people withdrawing their own IRAs or leaving it to kids, we tend to see the amount that's in the IRA and say, like, ooh, like I did good.
Right.
And
We
so,
overestimate how much money we actually have.
without a doubt. And so it's not until the withdrawal phase happens that we realize just how much is eaten up by taxes on the back end. We actually the other day made a graphic to go through that with our kids to try to explain Roths to them because they were very interested.
Speaking of kids and Roths,
Yes.
if you find yourself in a position where you are a business owner and you are approaching retirement years, maybe you're in your 50s or so, and your kids are old enough, maybe and why by old enough, they just need to be old enough to be able to meaningfully contribute to the earnings that they're going to get. So you could
To
have
earn
them.
income.
What did you guys used to stuff envelopes? I think to prepare tax returns.
Yeah, so
And you
my
were paid for
parents
that when y'all were
exactly.
kids,
My
right?
parents had an
6 and 8.
accounting firm, and so we would, stamp envelopes, seal them shut, and deliver tax organizers to clients around the building.
Right. We could
It
do a whole show
pretty
on it.
simple.
We
Yeah,
could do a whole show on what you
we
could do
really
here
should,
from a planning
but
perspective.
it is a
But you
good thing
can
to know
think
here.
about like, I want to transfer assets to my kids. What's the best way to do that?
Yeah.
You could employ them. You
Yep.
pay no FICA taxes if they're under 18, working for a sole proprietorship or a partnership
Correct.
owned by the parents. And then you can put that money straight into Roth IRAs. Now it's growing tax free
Yep.
forever.
Separate and apart from that
Pretty great.
$18,000 gift
Counts
we
as earned
talked about.
income.
Yeah, yeah, yeah,
Exactly. So
exactly.
just really cool
There's
stuff that
lots of
you can do,
things.
right? So the idea is you just want to be thinking about this
Correct.
so that, you and your plan, or just you, if you're doing it yourself, so you can think about the options that you have,
Mhm.
and then start to pursue those options and engage with them, right? So we said Roth IRAs are beneficial.
For the kids, what else?
Equity positions are going to be more advantageous. So Roth IRAs both for you and your kids,
Right.
right? That's
No, 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 but,
the
this is, just a reminder that this is the scenario of I
we're
wanna
still in
leave
the
money
bucket
to
of
my
I want to
kids.
leave money to my kids, right? So generally speaking, you're going to want assets that are going to grow more.
Correct.
You're going to be a lot less interested in things like an annuity,
Right.
right?
Looking longevity here.
Right.
Yes.
Especially things like a SPIA, single premium immediate annuity, where
Yeah.
I give you a huge amount of money and then you give me less money for like the course of my lifetime, and then when I'm dead, it's gone,
Correct.
right?
Correct.
So
Okay.
you're going to be a lot less interested in that, probably marginally less interested in fixed income, that kind of thing, right?
Right.
So next category,
All right. So next we're talking about charity.
charity.
Leaving our money to
Right. So
charity.
this is interesting because I've heard people talk about uh I've heard people talk about like Roth conversions and how should I think about this, and it can be beneficial. You gaining tax arbitrage benefit, and what I mean by that is if I'm in the 22% bracket today, but I think I'm going to be in the 32% bracket tomorrow or next year in the future years,
Yeah.
then it
I
might
think
be
it's going
beneficial
up.
for me still to pay tax maybe up to the top of the 24%. So I pay tax at 22% and 24% and not more at 32%, right? So I'm gaining really there the difference between the 32 and the 22, so that 10%, and then the 8% arbitrage is what I'm calling it.
Mm-hmm.
Okay, so you can you can still do the Roth conversions, okay, and that makes sense. But if you're going to leave all of this stuff to charity, we talked about the beneficiaries being able to rip the money out tax free. Well, if you have it in a tax deferred account like an IRA, charities don't pay tax, so they can rip it out tax free
Mhm,
already. Does that make
mhm.
sense? So it's marginally less advantageous. I'm not saying don't do it, right? There's certainly situations where you would do
Right.
it, and it would benefit yourself to do so.
But you're not
You see what I'm
saving
saying?
the
We're just talking about
$1,000,000 from being
right.
600,000.
We're talking about the margins here, right? So general rule of thumb, broad strokes, you're going to be more happy to have more money in an IRA because that maximizes the amount the charity gets.
Right.
If you take the money out, let's assume my tax rate is 20% and I have $1 million.
Yeah.
Okay. If I convert that $1 million to a Roth and I pay 20% tax on that,
Right.
the charity then is going to get 800,000.
Mhm.
I paid 200K in taxes,
Correct.
right? And now I put the 800K in a Roth. Well,
Exactly.
charity now gets 800K. So if my goal is maximize what the charity gets, I should try to leave it in the IRA,
Mhm.
right?
Exactly.
And
Exactly.
maybe I pay more on like taxes from my um on my annual income tax
But
returns.
again, that's only if you believe that your tax rate's going up, right?
Correct.
So there's definitely things to think about there. And I think that if you're trying to decide, like, do I leave it in my IRA? Do I do a Roth? It is very situational for you. You certainly want somebody to look at it. But like Eric was saying, when you're talking about leaving it to your kids, you end up with you end up with significant comparative benefits to the Roth versus the IRA, whereas those comparative benefits do not exist when you're talking about with charity.
Right. Right.
Um, okay, anything else regarding charity?
They're probably QCDs are a big deal. So IRA you can I think it's 105,000 is the 2004. I'm sorry, 2004. I wish we were in 2004 again. I'd be a lot younger. Um, 2024
It's
annual
really different.
exclusion is $105,000 of qualified charitable distributions.
Okay.
What that means is you can take $105,000 out of your IRA, okay? And it is excluded entirely from your taxes. And you might be thinking to yourself, well, wait, I can always write off charitable contributions on my Schedule A, Eric. And I would say, touche. However, at that point in time, you're having to forego the standard deduction to do so.
Correct.
Does that make sense? So, like, maybe it's not advantageous for you to itemize, but you still want to give some money to charity. Okay, so you can initiate a QCD and just exclude that from your taxes entirely. It's also helpful for things like IRMA brackets.
Mhm.
Okay, so your modified adjusted gross income, Maggie, for IRMA purposes and for every purpose, is not going to include any of the amounts of your qualified charitable distribution. So it's not going to include that 105,000 if you're
Right.
going to cap it in 2020 or if you're going to max it out in 2024.
Exactly.
And I know how happy everyone is to talk about taxation.
Mhm.
I love it.
Well, in all honesty, though, while the majority of people I think are not happy to talk taxation, we're all happy to have someone in our life who wants to talk taxation because while no one wants to talk about it, no one wants to pay it. So being
Mhm.
able to do whatever we can to minimize the lifetime taxes that are paid is huge.
Yeah,
And so typically at this point is when hopefully you either are comfortable yourself doing it or you have found a reliable like fiduciary to have in your life to help that because in order to make sure that's happening, like we always talk about minimizing lifetime taxes. This is not a one and done. This is not a 1 year plan. You're
correct.
good. We're talking like a consistent relationship with somebody that you trust from start
Very
to
important.
finish.
Very important.
And we'll talk a bit about the importance after we talk about
I'm
the
noticing that this
taxation
is
piece of
going
it.
to definitely be a two-parter. 100% going to have to be a two-parter. And I apologize, but that's the fact, Rachel.
No, I don't think so.
I do. So anyway, let's keep going. Another part of what because we're not even finished with charity, Rachel. We're not even finished. We're not close.
Okay,
Oh,
yeah.
maybe close.
Good, good.
So one of the things that we could do also is what's called a charitable remainder annuity trust.
Okay.
And for everyone listening, you're like, I don't care. I don't know what that is, and I'm not interested in what it is.
The,
Just layman's terms, you give a
they
huge
may
amount
have
of money.
also heard it referred to as a what?
Correct?
Yeah.
Um, so charitable remainder annuity trust, typically you'll give this to maybe like Tulane, right? I'll go and say, hey, Tulane, I'm going to give you $2 million. And Tulane will say, great, I'll pay you 6% on your 2 million every year until you die, and then I get what's left. Okay, so that's essentially a charitable remainder annuity trust. You give a large sum of money to charity, you take the tax deduction for the future value of those dollars, or it's the present value of the future dollars today. So I get a tax deduction, a tax benefit to myself, and I'm getting essentially an annuity, right? So it's almost if your goal is to maximize gifting to charity, it can be thought of as like better than an annuity, right? Like than just going and getting your like single premium immediate annuity.
Well,
So
talking about an annuity leads us right into our third
correct.
group.
Yes. So the
So
sorry,
our,
go on.
yeah, no, no, no. Our last group was I want to spend every single
Every
cent,
dime.
right?
Yep.
And it's frequently referred to as the bounce the last check group, right?
Yeah. I want to bounce the last check to the funeral home.
Yep, exactly. So if I want to, I worked hard for this money, I want to maximize my use of it. I don't want a pile of money sitting there with nothing.
Yeah.
Particularly, you'll see this with people who don't have children, don't have any,
Kids,
right.
not
Well, you'll see it
particularly
with people who
charitably
do have
inclined.
kids, and they're like, you make enough money.
Correct. Yeah,
I
no,
made
it's
this,
it's a fair
which is
value judgment to make.
okay. So if that is your goal, you're probably not looking at a Roth, right?
Right. Well, again, Roth has benefits to you within
Right
your
now,
lifetime, but
without a
again,
doubt.
zoomed out, broad strokes, you're marginally less likely to be excited about a Roth.
Right.
Does that make sense?
Well,
Just
and at this
very
point in
marginally.
time, I would
It'll
like
still be good.
you're further on in your life, right? When you're starting to look at
Yeah.
kind of some of your estate considerations, because presumably things change.
Mhm.
Actually, that brings me to a side caveat. Just because you've made an estate plan does not mean like we're done. I never have to look at it. I never have to touch it. It's something that you want to be at least like looking at or reviewing probably annually just to make
Right.
sure that
Yeah, make
this,
sure things haven't changed.
yeah,
You didn't get divorced or,
yes.
one of your kids didn't aid your house and you need to write them out now.
Right, the beneficiary piece is very important. And then your financial situation may change as well. So what you
Right.
had a plan for may no longer
Yeah,
be
not you might
maybe
not have a $3 million estate
you
these
might
days, but
have
now you might
a
have a
10.
$20 million
Exactly.
estate, and okay, we got to really
We
do
have
some
other
planning.
considerations. Exactly. Okay, so I want to bounce last check. What is my optimal play here?
Now we're talking things like single premium immediate annuity. I'm going to give you a huge amount of money, all my money, right? I might just do that and just say like, all right, give me a check for 15 grand for the rest of my life, and I'm calling it a day. Like if
Mhm.
you do that, I'm happy and we're good to go. So I might go to an insurance company and do something like that. I mean, you can do that with the plan to even take some home equity out at the end of your plan if you own your house, presumably. You could do that with the idea that like worst case scenario, I have this annuity and I'm just gonna go live in whatever home this annuity can afford for my end of life care.
Right.
I've got Medicare, I've got Social Security, and now I have this annuity stream, and I just get to go spend this.
Correct.
That's it. And
Correct.
so I can try to design the annuity with like an inflation adjustment rider,
Right.
so I know basically what my budget is from here until forever, and then I just get to go and spend that.
Exactly.
So
Um,
that is an option. I mean, alternatively, you could just if you're just not into that, you could do things like high yield savings accounts, right? Like things that are like super secure. Depends on your risk tolerance. You could let it all ride on Nvidia if you really wanted to, but we would probably say no, like because it doesn't matter, right? Like Nvidia moons, like if it takes off, like
right.
you get an extra couple European trips, but you don't have any charitable interests.
Yeah.
You don't have any interest in your kids, so now your estate is what like 10 million to go to nothing.
But also, well, exactly. And at the point in time that you're getting these extra European trips, you're probably looking at being unable to bathe or dress or
Right,
like
right, exactly.
we're looking at the point in your life where
And
you're
that risk, I mean, you would,
stable
we would
to,
never. I'm kidding here, right? Like you're
yeah.
never going to be 100% in Nvidia. No retiree will we ever advocate be 100% in Nvidia or any
There should be
meaningfully large
someone
percentage.
somewhere though.
Maybe,
Good
but
luck for him
it's not
or
somebody that we're
her.
going to be working with.
No,
Um,
or it probably isn't working, but
right.
anyway.
So typically that's not going to happen,
Yeah.
right? Um,
And again, I think it's important to point out that the three scenarios that we're discussing are on extreme ends of the spectrum. Um, I think that we tend to see a lot more on the end of the spectrum with I want to leave as much to my kids as possible. Um,
mhm.
but typically we have people fall,
Yeah, they're
somewhere in
everywhere.
the middle. Exactly.
Correct.
And so again, there are all sorts of like hybrid plans and pieces that are there. So I think when we move into part two, then part two is going to really
Oh, so you came around,
yes.
huh?
No, I think we would be fine, but
Oh
you
yeah.
already
All
had
right.
left. So since he's checked out, but so the other piece that we really wanted to touch on and will touch on are, the things like the power of attorney, medical directives, things like that, that
Mm.
are really important to make sure that you are obtaining in a very trustworthy manner.
Yeah, this stuff's important.
Yeah. Right.
That's why I'm smiling so much. Um, if you enjoyed today's episode, please review the show. And if you have any topics you'd like discussed or financial problems you'd like solved, reach out to us at podcast@equilibriumfp.com or visit our website at equilibriumfp.com. And please feel free to send us your individual scenarios and just say, hey guys, this is what we are. This is where we are.
Yeah.
What are your
What are your
thoughts?
recommendations?
Yeah.
Exactly.
Give us your general thoughts.
Yeah.
Anyway,
Perfect. Till next time.
thanks, guys.